I'm Jeff Enright with Kidder Matthews, and as the events chair for the Northern California chapter of the Counselors of Real Estate, I'm happy to welcome everybody to today's program. This Zoom meeting is being hosted jointly by the Northern California chapters of the Counselors and the Appraisal Institute, the leaders of which we're going to hear from shortly. This is the first time we've done one of these events that our chapters have co-hosted together, and today we're proud to bring you three renowned speakers who will be covering both current economic conditions related to the COVID crisis, as well as more in-depth views of conditions specific to the lodging and hospitality sector. Andrew Nelson of Nelson Economics will be leading off in a moment with a discussion of broader economic conditions and a brief analysis of the property markets. And he'll be followed by Elaine Solins of Cushman & Wakefield and Suzanne Mellon of HVS, who are both going to focus on the hotel sector. But before we start, I'd like to go over a couple of housekeeping items related to today's program and also give the chapter presidents of the Counselors and the Appraisal Institute the opportunity to say hello in a few words. As most who are here today already know, this event is actually replacing what was originally planned to be the NorCal Counselors chapter's in-person tour of the newly opened Grand Hyatt at San Francisco International Airport. That program, of course, was canceled because of the shelter-in-place order, and we're hoping to be able to reschedule that a little bit later in the year. We'll keep everybody updated as to that plan going forward. We're also considering hosting more of these types of webinars in Zoom meeting formats, which we'll talk more about at the end of the hour. Regarding this program, the event today is being recorded, and both it and the materials that are going to be presented will be made available in some format for future viewing and/or download. But because this is a live event, everybody who's come into the program is initially muted, just so you know. Your computer camera may be showing your image, however, depending on what your personal Zoom settings are. And if you'd prefer not to share that view, assuming it's on, look at the bottom lower left-hand corner for a stop video option, which will replace your image with your name if you choose to do that. We're also going to have a Q&A session as part of this program near the end of the hour. It's going to allow everybody who's listening in today the opportunity to ask questions of today's presenters. This will be moderated by the Counselors Chapter Events Vice Chair, Melissa Bach, who will introduce herself a bit later in the program. During the three presentations that will follow, please feel free to use the Zoom chat function, which is again at the bottom of your screen, somewhere near the center, to go ahead and type in questions. Please address those to Melissa specifically. She'll organize them and field them and ask them of our presenters when we get to the end of the event. And with most of those issues out of the way, I'd first like to introduce Eileen Marinin, President of the Northern California chapter of the Counselors of Real Estate. I'd like to invite Eileen to say a few words to today's attendees. Maybe she's now on camera, but regardless, I'm sure we have her voice. Eileen?
Yeah, thanks. Thanks very much, Jeff. No, not my visual yet. Sorry, I'm for the first time this week having trouble with my Zoom interface, but I just want to take a minute, don't want to take much time from the program, but to welcome everyone, all my Northern California colleagues at CRE, and as well as the people that are calling in from the Appraisal Institute. Welcome and thanks for joining us. Wanted to say a few words if you're not familiar with the Counselors of Real Estate. We're an invitation-only organization of seasoned real estate professionals, broadly construed people that do real estate advisory in any capacity. So we have a big range of people who are members, predominantly in the US, but increasingly with an international membership, and from small to very big organizations represented. I've been a CRE for about 15 years. I found it to be a very friendly and collegial group. And what we are doing right now that we're all sheltering in place is, I know the headquarters folks, Paul and company in Chicago, are putting on more and more programs like this one from the national perspective. Last week I sat in on a talk Richard Barkham gave. He's the global global economist for CB in Global Investors, and was very interesting and surprisingly bullish, I thought. But there are more of those. We'll be trying to do more as well. So check out the CRE.org website if you're interested in participating in any more of these. And now I'll hand it off, I guess, to Carol.
Oh, okay.
Well, thanks, Eileen. This is Jeff again. Let me just do a quick introduction of Carol. No problem at all. Thanks for your words. The leader of our co-host organization today, Carol Laval, is president of the Northern California chapter of the Appraisal Institute. And with that, Carol, a few words. Say hello, please.
Yes, thank you, Jeff. I'm Carol Laval, and it's my extraordinary privilege to be president of our Northern California chapter of the Appraisal Institute this year. And the Appraisal Institute, I think, as most of you know, is a 90-year-old organization, and our chapter is about that age as well. We have a little more than 500 members, and we actively, we have a lot of educational offerings. We're in the process of taking our normal in-person offerings to virtual like this. And I am delighted that we're working on this together today. And I hope that we do many more in the upcoming year. Thank you so much. And off we go.
Carol. Thank you very much. Thanks. And with that, I'll now turn things over to our first speaker, who, as I mentioned before, is Andrew Nelson, CRE of Nelson Economics. Andrew is going to provide us a broad economic overview of where our national economy is currently, how it's being impacted by the COVID-19 pandemic. It's going to touch briefly also on the property markets. And by way of an introduction, Andrew is a real estate economist, an author, and a speaker who formerly served as chief economist for Colliers International, and he managed Reef's U.S. research team at Deutsche Bank. He joins us today from a home office in Fayetteville, Arkansas, where he's sheltering in place away from the West Coast. And Andrew, if your slide deck is ready, please feel free to share your screen, and it's all yours. Take it away.
Let me try. Come on. There we go. Now let's get to a, okay. I'm on screen and you can hear me?
Yes.
Looks good.
Great. Good afternoon, everybody. Thank you, Jeff, and to the leadership of both organizations for the invitation. I wish I had better news to deliver, but it's hard to put a positive spin on the worst pandemic in a century. So here goes. I'd like to start with this graph of restaurant reservations on OpenTable, which I think neatly captures how the pandemic is hitting the economy. I mean, to be sure, the dining sector has been hit harder than most parts of the economy, but it does illustrate a few points. The first is just the speed and extent of the decline, which really is unprecedented, to use a term that's getting now an unprecedented amount of usage. But what it means is that it's going to be very difficult and challenging to not only use history as a gauge of where we are or where we're going. The second thing to notice is that this recession started before the government shutdowns. Restaurants reservations were in free fall before the government was ordered to close the restaurants. And certainly that intensified the decline, but it did not cause the initial plunge in demand. And for the same reason, the recovery will depend much more on consumer confidence and consumer demand than it will be on what activities we're legally allowed to do. So, you know, we're going to be turning up the dimmer on the economy and not exactly flipping a switch. The third point I would make on this chart is that, you know, although on-site, you know, dining is an extreme case, we are starting to see, you know, a glimmer of recovery in the economy. as we start to reopen different parts of the economy. But still, the recovery, is very, very limited, and we have a long, long way to go for recovery. And that path to the recovery is directly related to how well we control the spread of the virus. And although we're making progress, the record here is very much a mixed story. The good news is that we are starting to flatten the curve and reduce the rate of transmission. But the US is still recording more than 20,000 new cases every day. And part of the reason might be better testing. But if you look at other data like hospitalizations and deaths, it's clear that the virus is still very much with us and even starting to rise again as we start to reopen the economy. The New York Times reports that cases are rising in 9 states. It's stable in 25 and falling in 18. And if you're wondering about California, it's also a mixed story. The disappointing news, and I found this pretty surprising, is that even with all the extreme measures we've taken here, the number of new cases each day is still peaking and has been increasing in the last week, showing no signs of falling. The better news is that per capita rates of infection and of deaths are much lower here in California than nationally, especially here in the Bay Area. Still, it's hard to be optimistic knowing that these rates are stubbornly high and poised to rise as we reopen the state. And this pandemic is having just a devastating impact on the economy. No doubt you've seen some version of this data. I mean, the unemployment rate had been hovering at a 50-year low of about 3.5% last year. It surged in only 2 months to 15% as we lost a net of over 20 million jobs. And then if you include to that people who are working part-time involuntarily or who have given up looking for work but are still technically in the labor force, that underemployment rate shown in red is up to 23%. And even that understates the loss in employment because it doesn't include gig workers who've lost income or many other people, full-time employees who have lost income, or people who just dropped out of the labor force. In fact, a census report released just today shows that almost half of Americans have lost employment income in the last 2 months. To put these job losses in perspective, we've lost over 20 million jobs, which is shown on the right in red. We've lost more jobs in the last 2 months than we gained in the last decade of expansion, and about 3 times as many as we lost in the financial crisis. So again, unprecedented. Last point I'll make about the job market. These job losses have touched pretty much every sector of the economy, and the service sector has been especially hard hit, which is unusual because usually in a recession it's the factories and goods producers that get hit harder. But this turns out to be relatively good news because it's generally easier to reopen services like hair salons or stores than it is to restart a factory. So that should accelerate the recovery. Now we focus on the labor market, in part because it's a timely gauge of economic health, but also because it's such an important and reliable indicator of future economic trends. And so too with business and consumer confidence, which are highly correlated with business investment and consumer spending, which together make up about 85% of the economy. So we care a great deal about how firms and households are feeling. And as you can see, both the indexes for manufacturers in red and for service firms in blue and for consumers in red, they all have plunged in the last 2 months. Now, the modestly good news here is that we're not yet at the depths that we reached in the last recession. Still, the trends are worrying. And if firms stop investing and if consumers stop spending, the recession will be that much deeper. And already we're seeing signs of that. Retail sales, shown in the blue line on the left, had the biggest monthly declines ever in March and April. Same with factory output on the right. So all in all, some pretty grim news. Now, there are some tentative signs that we might be bottoming out, even turning the corner. The labor market has some modest improvement. The number of unemployment claims has fallen now for 7 consecutive weeks, which is good after peaking in late March. But there were still almost 2.5 million claims filed last week, which is about 4 times higher than the highest weekly amount ever before this pandemic. So not exactly great news, but at least the trend is going in the right direction. Also, the decline in the total number of hours worked has bottomed out, as we're seeing furloughed workers being called back to work. So that's good. And other kind of dormant parts of the economy are starting to show signs of life, though the level of improvement varies by sector. So what can we expect? I'm going to go out on a limb here and say that we actually shouldn't be surprised if the unemployment rate starts to reverse course and fall somewhat in June, if not in May. 90% of the people who lost their jobs in the last couple of months were classified as temporary furloughs as opposed to permanently laid off. So theoretically, they can be called, relatively quickly as lockdowns are eased. Particularly since most of those jobs are in services, as I mentioned. But it's also worth noting that the economy is still creating lots of jobs at grocery stores, at warehouses, at delivery companies. I estimate almost 10 million jobs have been created in the last 2 months, which may surprise you. But I don't have time to go into the details here, but I did publish a paper on my website if you are interested. So I do expect somewhat of a bounce back, this spring, but don't expect it to be anywhere near where we were anytime soon. Large parts of the economy are still operating at reduced levels, and many parts of the country are still on either lockdown or have significant restrictions in place. So we can expect a partial recovery at least. But I'm more concerned about this summer when budget shortfalls are likely to force historic layoffs among state and local governments. I think we can expect, as we reopen the economy and reduce restrictions, we can expect a second wave of infections, which is almost certainly going to cause more lockdowns. And my biggest concern is about the financial health of households and businesses. And on the left here, you can see that lower income households have been hit disproportionately. And many of them are going to go bankrupt if the economy doesn't turn very soon. Same thing with small businesses, many of whom don't have much of a financial buffer or the same access to capital. So we could see another sharp contraction this summer. What does it mean? Overall, the consensus call for second quarter GDP is for about a 30% drop annualized. Again, unprecedented. The respected forecast model from the Atlanta Fed sees it even worse. That's the green line on the right, about a 40% drop. Wow. Looking further out, we must, be humble and admit that it's difficult to say pretty much anything of consequence with any certainty. But, in sharp contrast to the relatively steady, if moderate, growth over the last decade, where we could forecast trends with pretty high conviction, conditions now are so dynamic and uncertain and unprecedented that I don't really believe anybody's models. I mean, I'm a big fan of Oxford Economics, but they've been continually revising their models down. I think at best we can hope to capture the broad contours of the recession. This is what Oxford is saying now. And though there's a significant downside scenario, the so-called, W scenario. Moving back from the specific numbers, I think focus more on the trends. What seems likely is that it will take years to get back to the pre-pandemic growth path. But of course, not all parts of the country are going to grow or fall equally. Again, here's from Oxford. I think that, the relatively good news for the Bay Area is that they and the Bay Area and other tech heavy metros that have a lot of professional services should fare pretty well, which seems at least directionally right. So where does that leave property markets? Perhaps the best way of summarizing it is to, follow the, as they say, follow the money. And as of right now, it's on the sidelines. Lenders surveyed by the Mortgage Bankers Association overwhelmingly say deal flow is either weaker or much weaker than last year, pretty much, across all sectors, which sounds about right. I mean, we're in the price discovery phase, and I'm glad I'm not trying to value properties right now, because it would be quite challenging. So, in terms of looking where, a little further out, in terms of, the individual sectors, I mean, clearly the biggest losers are physical retail, travel-related uses, which we'll get into in a moment, flex office space. More neutral is probably multifamily. For now, incomes are being bolstered by the PPP and other income support. Rents are being paid, but we'll see for how long. The big winner, of course, is warehousing. And then looking further out, I mean, there's going to be there's just a lot of uncertainty as to what it's going to look like. We can expect to see some pretty profound shifts. Again, the biggest losers will be physical retail, just reinforcing trends that have been over the last few years. But office faces a surprising challenge, and I think it's still too early to know. But the early signs look pretty threatening. I mean, just today, Facebook announced that they see half of their workers working remotely permanently. So I think we're going to be seeing many tenants revisiting, their assumptions about the workplace. So let me, and if you're interested, by the way, I did write an article for the CRE Journal, which is available online, and I go into more detail about the property markets. For now, let me just conclude where I started. The economy is facing, a major and prolonged downturn with much uncertainty, about the strength and timing of the eventual recovery. And risks seem very much weighted to the downside. It's hard to see how we make anything approaching a full recovery until we have a proven vaccine and effective treatments, which seems like a long way off. So on that happy note, I'll thank you for your attention, and I'll look forward to answering your questions after the other presentations. I'll now turn it over to Elaine Solins to start the hospitality discussions.
Oh, sorry about that, I was muted. Okay, thanks so much. Dovetailing into one of the sectors that's been incredibly affected, just want to give a little preamble to this. We have a lot of topics to cover. There's so much information on this. And one of the actual benefits of being in this age once this is happening is the wealth of information online has been incredible and free. There are webinars every day, articles, data, economic forecasts. It's just, you can track the situation in real time. But things are changing every day. So I'm going to talk fast so I can get through some of the material. Just to give a little background, before we came into this COVID period, which is hard to remember before, we were in a period in the hotel industry where things were kind of slowing down. There was a general acknowledgement that occupancy was moderating, average rate growth was slower than it had been in prior years. And the expectations over the next few years were fairly modest, with revenues, what we call RevPAR, revenue per available room, somewhere in the maybe 0.5 point to 2% point of range for the next 3 years. So we were looking at a softening market, but we weren't expecting, obviously, what happened. So in the first few months of the year, January and February were right in line with expectations, and boom, came March. And this is the national trends. We really fell off a cliff pretty quickly. As you all know, The hotel has no leases. We're incredibly volatile. Things can go down very quickly, and in recovery, they can come up fairly quickly. The impact was not uniform. These are from the STR, Smith Travel Research data. We use their numbers. They track all of U.S. hotel performance from every night. They get rate and occupancy from every property, and they're the gold standard in terms of data for the industry. And they track 25 markets. We've been tracking them. They've been tracking them since about 30 years. And as you can see, the urban markets, which you would expect, were hit pretty hard. And San Francisco was hit the hardest of all the markets that are being tracked. And I'll get into that in a little bit. And again, that was not uniform in terms of the type of properties tracked by STR. These are chain scales, which are the categories based on rate. And luxury markets have been the hardest hit. Whereas markets which are more economy oriented, particularly those on highway or those that cater to an extended stay guest population, have done a little bit better in the new economy. So in terms of San Francisco, we also were trending down through the last couple of years. With Moscone reopened, that was supposed to cause a little bit of upside. It really hadn't. There were more larger economic forces that have been challenging, and so occupancy has been slowly declining, which is a little bit skewed on this chart. It's really only a couple points, and average rate growth has slowed as well. But we were hit much more rapidly by the COVID impact, and there are a couple of factors to that. One is that we are a major international hub. So United Airlines accounts for 50% of the traffic at SFO. So when the airlines went down and traffic from Asia was stopped and moderated from other places, and San Francisco was hit quite heavily. In addition, 28% of our overnight visitors are international on an annual basis. So we're particularly vulnerable to the circumstances in this current pandemic. But I need to think about this whole problem, and not just in terms of hotels. I'd like to think of it in terms of the travel ecosystem, which Andrew alluded to, that we're part of a larger economic platform, and we all work together so that when something affects one part of the stakeholders, it affects everyone. And as hotels, we're actually a dependent industry. We're dependent on transportation, dependent on tourist attractions, convention centers, and everyday events. And airlines have been particularly challenged. This is the curve that Andrew showed in his slides. You're going to see it all the way through. I imagine most industries, it really just fell off a cliff pretty quickly. This is international and domestic flights, so the last since January. Events started to be canceled February, definitely in March. Forbes reported through April that 83 million people were affected by events that were canceled. We're finding there are three alternatives lately. You know, events have been moved to a virtual platform, such as the one we're on. Events are now also being postponed without a future date. And a lot of events have been scheduled for the end of 2020, beginning of mid 2021. It's particularly found out recently weddings. There are a lot of weddings have been canceled in the US, have been pushed toward the end of the year. But there's not a lot of optimism that those will actually happen on events that have been postponed. They're still subject to the same kinds of cancellations we've been seeing since the beginning of March. So what's going to happen in the recovery? Like Andrew, you know, it's really a sort of great unknown. But I've been thinking about this in terms of just the amount of choices that people have to make every day. And those choices are very individual and very personal. So we think about all these choices just on our day-to-day. Do we leave the house to go to a grocery store? Do we get gas? Do we get our car cleaned? What do we do? Do we let repair people into our house? So taking those choices and magnifying onto the travel platform becomes exponentially more difficult. Is it safe to travel? Do we need a vaccine? Are we going to become more comfortable over time as this progresses and more safety measures come into place? The issue of confidence and security is the biggest factor that's going to be in our recovery in the hotel industry. But that choice, as I said, is very individual. So here, this is just from the last week, different choices people made about travel and being outside. The top one is in Maryland, which I guess is crab season now. And so they've set up a situation where people feel comfortable social distancing, though I think there are people touching each other in this photograph. And then the bottom left is the beaches that we've seen the crowds just flow onto the beaches when they get reopened. And the one on the right is Qatar Airlines, which this just came out yesterday. They're going to have their crews in full hazmat suits. So I wonder what that says about the passengers, how confident they're going to be. But this is, you know, the variety of reactions. But to travel, I'm thinking there are three new considerations. One is you have to have a personal motivation, or a business meeting, or a convention, relocation. These have not changed pre and post pandemic. You have to have a point in order to venture out of the house. You have to have an ability to travel, and we used to not think about it. We would book an airplane, we would book a hotel room, get a rental car, but now you have to think about every step of the way and think about what's available. There may not be a flight between the two destinations you're looking for. Are the restaurants open? If you're on the highway, are there enough amenities or restrooms? Is it safe? How far can you go until you get to some kind of confidence barrier? Oh, I'm sorry. And the third is the means to travel, which falls into the economic issues that Andrew brought up, which is, will we have money to travel when we recover, both on a personal basis, and what will companies do? Will they have corporate travel budgets that will allow travel? In prior downturns, we've seen that's one of the first things that gets cut on a corporate level. And then again, if you're traveling and you're in a household, will there be childcare available for when you leave the household? And then what we have now that we've never had for any previous downturn is what happens when we come back. And again, another personal decision. Do we stay at home for 14 days? Do we have the space at home for 14 days? Is this something that we think about before we make the trip? So there's been some surveys over the last few weeks that have been done every week by MMGY, which is a data research firm, and the U.S. Travel Association. I apologize, this is small and difficult to look at, but my slides will be provided later. But basically it shows for most activities, the range is about high teens to low 20s, some in the low 30s for taking a domestic flight. But what really shines is travel by personal car. People feel safe, by and large, getting into their cars as an extension of their own personal home and personal space. So this doesn't bode well necessarily in the near term. But in China, a lot of us are looking to China as sort of an example of what's happened and what can we look forward to or not. And we are seeing some upside with the lift of the restrictions. There has been some growth in hotel occupancy. And again, this is just through the beginning of April. So, hopefully without this double shutdown that's happening, that will continue to rise. And in China, the domestic flights compared to last year, though, are still lagging. So there is some challenge there. But there was a survey done by, or a paper put out by McKinsey last week that said that China is actually more optimistic, just as the travel ban is lifted, that optimism raises and the confidence increases precipitously. So it's something when we're looking at this weekly travel survey, we'll have to see as we move forward with the lifting of restrictions, how the confidence grows. And as Andrew said, we are seeing some glimmers of hope. There has been increased airlift in the last week. And as STR said recently, things are less terrible, that there are little glimmers of occupancy. And this goes back to the different categories of hotels. And you can see, again, luxury class being the hardest hit and the economy class and mid-scale being less hit. So STR has put out a forecast this week for the remainder of the year based on what we know now. And they are looking at overall demand falling about 45%, ADR falling 21%, and RevPAR 57%. But these are just the relative percentage levels. And what that translates into is an overall occupancy by the end of the year of 36%, which I want to say I've never seen in my lifetime. I don't know if it's ever been recorded that low, maybe since the Depression. But then with the rebounding beginning pretty immediately toward the end of the year and lifting to the 52%. And the average rate hit, well, it's 20% to some, that's about what we were hit in San Francisco in the first year of the financial crisis. It's going to take a lot longer to get back to that. And that's more of a concern than the hit on occupancy, because as I said before, hotels are re-rented every night, and you can increase precipitously, but the average rate is a harder road to hoe. So generally, those firms that are forecasting a 4 to 5 year recovery on the lodging industry nationally, occupancy increasing than average range, and demand has to be strong enough before there can be the pricing power to drive average rate. So if occupancy rebounds in the next, what's being shown is 3 to 4 years, the average rate is being forecast to return just to 2019 levels by 23-24. So we've lost any kind of growth. It's really just a nominal increase at that point. Lift is expected to increase pretty consistently, as you would imagine, with that trend, returning to in 2023 to close.
Lane.
Can you hear me?
Now I can.
Okay.
Yeah.
Sorry.
Oh. Lane.
Elaine, it seems you've cut out
Yeah,
on the audio.
we've lost you.
I'm gonna go. Is this okay? I'm going on my headset.
Yeah, we can hear you now.
Okay, I'm gonna go on my headset. Sorry about that. From an operations perspective, it's a day-to-day picture, and there's kind of this perception that the whole industry is closed, and that's really not true. On a national level, only 18% of hotels have closed in the U.S., and most of those are full-service hotels in urban markets. In California, we're limited by the shelter-in-place regulations. Hotels are open for essential workers and uses related to COVID-19, but not open for recreational or leisure use. And that's part of stage 3, though I've been tracking reservations online, and hotels are showing that they're starting to take reservations in June and July. Whether they actually take those or not depends both on the state levels and whether there's ample volume in each hotel to support adding staff. Staffing for closed hotels and those that are running in low occupancy levels below 20% are often about the same levels. But there has to be a business case for each point in occupancy to raise staffing. So travel recovery is going to begin locally by car, and this is pretty much accepted all over the country, and it goes back to the confidence level of being in your car. We're seeing in Atlanta, I've talked to operators who have hotels that have reopened there or starting to see leisure demand, and it's mostly staycations. People just have to get out of the house and want a different place to stay. The group and convention recoveries can be more problematic in terms of personal safety, in terms of the isolation and the social distancing, and then what companies will allow in terms of liability and their people traveling. The picture on the left looks absolutely quaint. You almost would think you were in the 19th century just a few months ago. And now we're on Zoom, and is that going to replace sort of a lot of the trends of the future? These are questions that we'll have to see play out. And this is all pointed to and has been sort of magnified is the hotel industry is incredibly fragmented. You think we have a lot of big brands, Marriott and Hilton, and those do dominate the branding of the industry, but really the hotels are all individual businesses, and there are tens of thousands of them, thousands of owners, hundreds of management companies, dozens of brands, and thousands of owner operators, and each of them has their own protocols and their own management style. Even though they have brand specific, it's really up to the individual employees in each property to make it work. So while there's been a proliferation of cleaning manuals and marketing about safety, it's going to come down to every hotel and every employee in every hotel. And just to illustrate the variety of practices, when we've been talking to operators, areas like housekeeping can range from checking guests into every room, every other room, every third room, leaving room vacant for 3 days before someone checks in or not. Definitely sanitizing before people check in, but if you check in and you want housekeeping, sometimes it's a matter of leaving your dirty sheets in a garbage bag in front of the door and they'll replace it. Sometimes they'll request, the management requests that the guest is out of the room for 3 to 5 hours while they let the attendant in for 30 or 40 minutes. So again, a range of how this is going to play out. Food and beverage is mostly shut. I can't think of a hotel where I've heard that it's been open. It's now grab and go. It's relying on the meal delivery services. Meeting spaces are now warehouses. Public areas, the lobbies are everything from maintaining the same furniture with patrolling them by management to removing some of the furniture to maintain social distancing. And the pool and fitness centers are real flashpoints. A lot of hotels are closing their fitness centers. Some are spacing out the machines and putting sanitizing equipment, amenities in, and others are keeping the pool open because that becomes a reason why people are coming, but they have patrolling the use for social distancing. But all this is really a drain on the hotel in terms of management, but what's also a real drain is the need for cash. And whether a hotel is closed or open at minimum occupancy or is ramping up, the challenge for a lot of operators has been the availability of cash. And those that have a greater cash reserve are likely to survive longer, because we know we've been reading all the issues about debt service and hotels going to special servicers and working out of banks, but they have other obligations which are also draining their coffers: property tax, back pay, cancellations. A lot of hotels have cut off their payments to vendors, and now that they're starting to ramp up, they have to come to true up with those. There's new money expended for cleaning equipment and the ongoing occupancy, payroll even during low occupancy. So now we've considered that there's 3 landmarks for hotels financially. The first one that I've heard is, where do you want to get to? We want to lose less money. Then we get to the point where we can break even. And generally what we've been hearing is that's about 30 to 40, 45% occupancy, depending on the hotel, the market, the price point. Mm-hmm. And then finally profit. And that's going to be more elusive. Again, going back to the ADR recovery, that's going to be one of the real indicators to see when the hotels can be more profitable. And with that, I'm going to turn this over to Suzanne, my former colleague and friend, to talk about how all this impacts hotel values.
Great. Let's see here. Hang on. Can you hear me? No. Yet.
Yeah.
You can hear me? Okay.
Yeah, it's working.
Very well.
Amazing. I just have to get this into full screen mode. Why is that like this? Hang on a second. Why?
A little further to the right.
What did I do? Hang on. Here we go. Can you see that? No.
Yeah, it's showing, but just not in full screen, but it is on screen.
It's pretty big.
It's full screen on my thing. Resume share. Hang on. New share. How's this new share? PowerPoint. How's that? Is that better?
Oh,
there we go. Perfect.
Okay, great. Thank you. Thank you to everyone. Thanks for holding this. I'm a proud CRE MAI, and Elaine is too. And thank you all for hosting this event and inviting me to participate. And thanks to Andrew and Elaine for teeing this up. It sounds pretty bleak out there, and I'm going to talk a little bit about the impact on hotel values, which, as you can imagine, based on everything you've heard, is pretty extreme. I guess I just want to start this saying that a lot of people are saying, well, how can anybody value a hotel right now? Like, it's just impossible to do, and anybody who says they can do it is misleading you. And of course, we do it every day. Elaine and I are doing it every day. We're valuing hotels for our clients. People want to know, and I know for a fact buyers and sellers are valuing hotels, lenders are valuing hotels. They're not too happy with what the values are coming out to be. So there's not much talk about what the conclusions are right now, because they're pretty dire. And I've also, having been through, a handful of these downturns before, I'm also well aware that you really have to slowly let the air out of the balloon, of the value balloon. People don't want to be told immediately, gosh, you've lost half the value of your hotel. It's just like looking at your stock market, your portfolio. And unless you sell, you're not going to experience that, that loss in value. But even just communicating with clients, we don't have any clear evidence of the devaluation of hotels yet. The transaction market's pretty slow. So at first you have to kind of be gentle with it. And over time, the decline will evidence itself. Right, so what I thought I'd start out with is just the trend in transactions. You can see this is from Real Capital Analytics. The total transactions that they track, 2.5 million and over, the red bars. And we've had a fairly active transaction market over the last few years. The recent peak volume was in 2015. If you look all the way to the right, you can see that we've had a tremendous downturn in hotel transaction activity. It's declined by about 50% just through Q1 of 2020. And that's, as you know, we still were having transactions through most of that time period. So it's going to be pretty dire, go down to levels, I imagine, the same as we saw in 2019, which was basically a stalled out market until the buyers and sellers see where things are falling out. And as Andrew put it, I liked the phrase that we're in the price discovery phase of the market right now. And we know there's a very significant discount between buyers and sellers' expectations. I just wanted to see, I guess I cut out a slide here. Yeah, so I just wanted to point out, of course, one piece of the whole valuation issue is the cost of capital. And I just put this slide in as a point of interest for the debt market. Historically, over time, the hotel interest rate, this is as reported by the American Council of Life Insurers, has maintained about a 200, give or take, 200 basis point spread over the 10-year T-bill. And you can see what's happened in the first quarter, and this is the ACLI is just through the first quarter at this point, probably likely to get worse. The 200 bips spread has increased to 500 bips, incredible increase in the cost of debt relative and the great drop in the T-bill yield. However, we are hearing that most lenders have withdrawn from financing hotels right now. There are lenders out there, but their pricing is pretty steep and they're typically looking for new equity. So a very different player or set of lenders will enter the market. But right now, hotel financing is very far and few between. And we're hearing that most transactions are, we're looking at seller financing or all cash transactions. That highlights what's been going on. And one thing that we look at to see what's going on are the lodging REITs, real estate investment trusts, and what's going on with their pricing. Some investment bulletins, actually I shouldn't source this as HVS, this should be hotel investment bulletins. You can calculate the implied cap rate based upon the enterprise value of the REITs relative to their EBITDA. And you can see that as of March, that cap rate had elevated pretty significantly to 10.5%. You can see in 08 it was 12.5%. And then after March, these investment bulletins stopped reporting this metric because now we're talking about most of these REITs having negative cash flow. So there is no cap rate to derive at this point in time. Did I put in here? Oh, at the top here, you can see just as a metric, the lodging REIT prices are down on average of 54% since the outbreak occurred of COVID-19. So that is a pretty steep decline, which is kind of indicative of hotel asset values where they may be headed. So just we wanted to look back in the past cycle, and as Andrew noted, it's tough to compare to the last cycle because it's so extreme this time around. This is the average price per key as reported by Real Capital Analytics, and it's the total volume each year of sales transactions divided by the number of hotel rooms that sold. So it's very much impacted by the kinds of hotels that are selling in any given period. And for the full service hotels, which are the blue lines, you can see they were already dropping in value until we hit the crisis and we had the plummet in sales prices in 09 leading into 2010. And then it looks like there was an immediate recapture of value. And this is very misleading because again, it depends entirely on what types of assets are selling. And what we found out is that as soon as the market hit bottom, when occupancy had bottomed out and we started to show an improvement in hotel revenue and EBITDA, There were well-capitalized investors jumped into the market, which we think will happen this time too. However, the types of hotels that sold were large, high-quality assets. The real estate investment trusts jumped in, and that's what caused this tremendous pop-up in value. And that doesn't mean that any single hotel all of a sudden experienced that kind of appreciation. And then you can see things moderated a bit when the REITs pulled out. If you remember, there was a bit of an issue with the financial markets at that time. But eventually, over time, the average price per key rose. A lot of that was driven by the lower cost of capital, not a reflection necessarily of earnings, but just the cap rates were coming down. So we'll see what happens this time around. RCA, recognizing the volatility and average sales price per key being so influenced by the kinds of hotels that we're selling, has developed a hedonic series, which is basically smooths out the fluctuations in the data. And this is an attempt to reflect, instead of the average price per key, more what the average hotel would be selling for over time. So it's a little different metric. There are definitions at the bottom. And you can see that this is for all hotels, the volume of hotel sales, and that the peak was in about 2007, late 2007, and volume didn't get back there, or the average price per key, didn't get back there until 2015. So from the bottom, from late 2009 to second half of 2015, we had about a 5-6 year recovery that it took to recover prices. And you can see over here that we've already been experiencing some value declines. The market's already been slipping a bit since late 2018, as Elaine had alluded to, the fact that the hotel industry had been slipping, revenue flattening, expenses rising, and so it was already being challenged. So we wanted to look at what happens to cap rates during these periods of time. And based upon what happened last cycle, the cap rates, again, this is Real Capital Analytics data, the overall red bars, the overall cap rate became elevated in 2009. These are based on sales transactions. So of course, if you're calculating cap rate on a sale in 2009, you're looking at trailing 12 income that was higher. And so it can affect your, what your cap rate looks like when you do the math. But all in all, we do see about a 50 to 150 basis points increase in cap rates during a downturn like this. The challenge right now is that there's no income to cap. Most hotels have no positive cash flow right now, and many of them have a significant cash burn, whether they're open or they're closed. So it's a very difficult metric. And anything that you cap, your trailing net income you're going to have a very high cap rate. Your current net income is either going to be low or negative. So it's really difficult to do any kind of direct cap approach right now. So we are recommending that, and this is how we're valuing hotels right now, is performing a discounted cash flow analysis. And of course, very uncertain in the future, hard to know how things are looking, but we do talk to investors and buyers and sellers and try and reflect the marketplace. And anybody who's a hotel investor has to be, by their very nature, an optimistic creature, because it's a very risky and volatile business. And you have to think that there's going to be a tomorrow and there's going to be a recovery. And there's tons of capital lining up. There are funds being created as we speak to jump in, because people who invest in hotels know the time you make your money is when you step in at the bottom of the cycle and ride out the wave as it recovers, and then sell. And that's what, so we are thinking that's going to have a positive influence on this cycle, and buyers are probably more optimistic than some of us more conservative people like me who are appraisers. So these are the discount rate trends, and you can see over the last cycle they became elevated during downturn, and then they trended down as again, we had very record low interest rates, but also just a very different investment environment, more stable investment environment, and now we anticipate that they're going to be heading up again. This I'm just going to touch on briefly, the whole concept of operating leverage, which Elaine touched on a bit. Hotels have a high level of fixed operating expenses, and so the rule of thumb is for every $1 you drop in revenue, you lose $2 of EBITDA. And so we did this analysis to show what happened in the last downturn, 2007 to 2009, and it's exactly what happened was kind of amazing. This is overall full service hotels for the US as reported by STR, overall aggregate performance. And you can see that this multiple plays out. And so this is the tough part of hotels. When revenue drops, your EBITDA drops twice as much. But on the recovery, it can go, it's a wonderful thing. It's a positive operating leverage. And in the last downturn, we had this nice recovery through 2014. Since then, it's been relatively flat. And actually, we've entered a period of negative leverage as of 2018. So hotels have really been struggling trying to get EBITDA increases during this flat revenue period. And now this is all going to change. The same thing metric applies for limited service hotels, a little bit less so because they have less variable expenses that will be going up and down during these volatile times. But what we are thinking, and this is the one hope in the industry, is that unlike past times when we go through a downturn and revenue's falling and operators kind of cut here and there, lay off, a couple of people, tighten up a few expenses in their operation. This time around, they cut to the bone, absolutely cut to an absolute skeleton crew if they stayed open, and if they closed, even more of a skeleton crew. And so when they start to rebuild, when revenue starts to recover, they're going to be very, very judicious on how they bring people back. So they're rethinking their entire operations, as Elaine alluded to. Daily housekeeping may be a thing of the past. There may be no more food and beverage. All these services that have been provided may no longer be provided because hotels just won't be able to afford them. So we're thinking as housekeeping, other service cutbacks, no more food and beverage, bringing back furloughed staff, just position by position, having people multitask, which will be challenging in unionized hotels. And this is why many people are thinking some unionized hotels may not reopen, because without the ability to get people multitasking and having rigid work rules, which is what you see in New York and places in New York and San Francisco, these hotels may not be able to reopen. But what we are hearing is that the break-even levels have come down. So where, I'm hearing of people, I was talking to someone the other day saying, well, I can break even at 20% occupancy. I was like, wow, that's pretty amazing. So it's, of course, it depends whether they're taking out reserve for replacement or not. A lot of lenders and operators have been letting the reserve for replacement be forgone during this period of time. But break-even levels have come down, and that's what people are hoping is going to help save the industry coming out of this at very reduced revenue levels. So that's the positive thing that we are hoping for. One other this point I just wanted to touch on, when doing a valuation, a discounted cash flow analysis, we've done some modeling, and if, based on the, all cash transaction or very low debt levels available, one might think that we'd have very elevated discount rates or cap rates, if you can use a cap rate during a time like this. And if you actually assume and build into a model a refinancing upon recovery of net income, and then you calculate what your overall discount rate will be, the impact on your discount rate, it's not as onerous as one thinks. So in this quick example, we assumed either an all cash transaction at 20% yield, or a 20% or a kind of a low leverage transaction. So assuming a 12% discount rate entering the investment, but then assuming that at the end of year 4 on recovered and stabilized net income, we assumed one could get more typical financing parameters. At the end of the day, when you calculate your value and you solve for the overall discount rate on a 10-year basis, it works out to be about 11%. So I'm just bringing this up because we're concerned about people over whacking or double hitting values when you're performing them. If you really raise your investment criteria and you're forecasting very discounted future net income streams, you might be undervaluing asset, because these people who are lining up to jump into this industry, there's going to be competition. They're all expecting a recovery. They're all going to expect to refinance at some point when income recovers, and really you need to build that into your investment parameters while you're going through the valuation process. Sorry, so here we go. And this just kind of shows that math when you refinance and you get your proceeds to equity, and how it results in basically around 11% discount rate. So we ran just quickly through, so I know we're running out of time here. I'm over the hour, I'm sorry. We ran some valuation scenarios. These are based on 3 different levels of recovery. One assumes that you're going to recover by EBITDA by value by 23, 24, 24, 25, 25, 26. And these are the value impacts. So we're feeling like that assets that are the least impacted, which are properties that are more in tertiary markets, limited service, extended stay properties, what have you. Drive-to markets, maybe 20% value decline. The average impact, 27% decline, and that was actually the value decline in the last cycle, according to RCA, based on their hedonic series, and then 35% to the most impacted assets. And I have to say, this is putting on a somewhat optimistic hat of letting the air out of the balloon slowly. I mean, we are hearing, stories of, again, this gap between buyer and seller. I was just told about an asset in the Bay Area for sale that there was an expectation that it was going to sell for $200 million. That was the pricing originally. COVID hit, and now they've gotten in 13 qualified bids, and the bids range from 100 million to 130 million, and that equates to a 35 to 50% impact on value. And having been through this before, Elaine knows this as well as I do. That's not surprising, but that's hard for people to swallow. There's no market evidence of it yet. There are a lot of well-capitalized buyers out there. We have to think willing buyer, willing seller. As appraisers, we have to weigh all these factors, and it may take time. Hopefully it won't be as bad as it might be. It could end up being that bad. We don't know yet. We just make our best call every time we are conducting our values. This shows these values recovering by 23, 24, 24, 25, 25, 26. So only time will tell. And this is my wrap-up side. Just there are things that are putting downward pressure on value and then upward pressure on value. Unprecedented revenue and EBITDA decline. We've got economic recession that will be deep, as Andrew has mentioned. Deep ADR declines. This is my biggest concern. ADR, as Elaine mentioned, is so hard to bring back. And that's really, that ADR reset is going to potentially have a significant reset on hotel values if we can't recover that average rate quickly. Right now, it's pretty devastating, the pricing on hotel rooms. The uncertainty regarding return of normalized travel patterns, which Elaine talked about, the potential for very prolonged recovery, and the cash drain, which may force owners to sell. Usually people like to hold on to their assets and wait. They just talk with their lenders. Everybody's telling me debt service and working with my lender is the least of my problems right now. It's costing me so much just to stay closed or be open that they could literally run out of cash and be forced to sell, forced to bring in new equity. And that's like a new variable that we new to this downturn. On the upside, we have improved business operating models, return of positive operating leverage, stronger than before, yield hungry funds lining up to invest in capitals, buy notes, what have you. And there's no yield on anything else right now, so they're willing to jump in. The low cost of capital is likely to continue, and lenders want to wait for values to rise before losses are recognized, so they are not going to be out there trying to do any kind of fire sale. So, and then the good news is there's always winners and losers, that whoever does have the money to step in at this point in the cycle, they have the potential for very high returns as we hopefully come out of this pandemic and travel patterns return to some kind of normalized level. And that's it for me. Thank you for your patience. Sorry, I'm a little past the hour here. I'll pass it back.
So we're at the Q&A section, and I actually, if you wanted to submit a question to Andrew, Elaine, or Suzanne, please do so. I do have a question for Andrew. How does the potential for a second wave of the virus in the fall affect your forecast models? Is that currently built in or disregarded?
Well, I think I showed two scenarios there. One that was more or less a straight line. I mean, it was more like that Nike swoosh that people are saying now, where there's not a second wave, but there was a second scenario that was shown that looked more like a W, and there's another rate, another downturn after rates of infection. I have to say, as I was putting together this presentation and digging more into the data, I'm not an epidemiologist, but the indications just look, pretty grim for that. About whether we're going to have a rapid recovery or what happens when we start reopening. So. had a assumption before just about we have to be humble. It's very difficult to get a handle on what the future looks like. These are very uncertain times, but I'm guessing that we will see some sort of recovery and then another downturn before we get into a sustained recovery.
So follow-up question, I think, Eileen, did you also want this to go to Andrew on your question? Is that also for Andrew?
Actually, I was really looking more to, I'm curious about our hotel experts, because of course, as they both commented, hotel reprices every day, so it's gone down first and hardest. So I'm kind of curious, and I have been wondering, so how are lenders actually dealing with their troubled hotel borrowers? Are we back to the extend and pretend from the GFC, or is everyone just doing it case by case, or try to figure out what the heck their policies are under the circumstance? I don't know. I haven't heard anything.
Yeah, I think they're back to the pretend and extend, is from what I've been hearing. And last time around, CMBS lenders are supposed to get an appraisal as soon as the hotel goes into special servicing, and they have been getting special dispensation on that. Nobody wants to know right now. The values are so impacted. You could wipe out several tranches of bondholders, and there's a fear that this could disrupt the entire bond market.
It could cascade. Yeah.
So they're hoping that values are going to they'll dip and then start to recover, and they won't start to recognize these losses until there's a recovery going on. My fear is that it's going to be so prolonged, and we know that sometimes these values can drift downwards for quite a time, and so it's just a real concern. I don't know, Elaine, if you have other thoughts on that.
No, I think it's a pretty universal story on that, and I think there was there are lessons which were great lessons learned from the last downturn, and we see more hotel owners not paying their mortgage sooner. So, beginning in April and May, we saw a lot of debt service not getting paid as opposed to dragging it on. And they're going right to their lenders and going right into special servicing, hoping that the extend and pretend does occur and goes on for a longer period, that they can hold on in some way.
Yeah, and then they can conserve cash. So I'm sorry, Melissa.
So another question for both Elaine and Suzanne is, how are you estimating values for Q1 and Q2?
Q1 of 2020.
I was just saying no differently than Q3 and Q4. We're doing forecasts, and all these stories about what is the curve going to look like, what is the recovery curve, or V or swoosh or whatever, based on what we're hearing. It's challenging in our market because we're still closed. I mean, you have some markets where they're actually open or have been open, and a lot of our properties are closed, so that's a little bit more speculative. But like Suzanne, I mean, we're of the philosophy that the hit is going to be in the income, and we're really more modest on any kind of changes in the valuation parameters at this point, until we see how it plays out. I think, again, another lesson learned from the last recovery is that all that dry powder that's waiting to get into the market, all the competition for assets really drives up the values and the pricing once it starts.
I don't have it. If anybody else has any other questions, I don't have any other on the board, but if anybody else has them. No?
Okay, well, I've got about 5:10 on the clock, which is a little past the hour, but that was terrific. Thanks to everybody for the presentation.
Yeah, thanks very much.
And the questions were terrific too. Specifically, I want to thank Andrew Nelson of Nelson Economics, Elaine Sollins, Cushman & Wakefield, Suzanne Mellon of HVS. Also our chapter events vice chair, Melissa Bach, thank you for fielding those questions there at the end. Our hosts, the CRE Northern California chapter and its president, Eileen Marinan, and the Northern California chapter of the Appraisal Institute and its president, Carol Laval. Thank you both for hosting this program today. Lastly, I want to thank as well, because he's run way past his time, our behind the scenes manager of CRE services, Paul Cody, joined us today from Chicago to make sure that everything ran smoothly, and it did. So thank you very much for that, Paul. And as a quick reminder, each of today's presentations and a recorded version of this program are going to be made available soon from the chapter offices and or their websites, both through the counselors and the Appraisal Institute. Look for communication from your chapters regarding that material being available. And as I mentioned before, our chapters are considering presenting more informational Zoom meetings like this. So please provide feedback to your chapter presidents and their offices and let them know if you felt that today's information was valuable. If so, what subjects would you like to see presented in the future? And if you're interested in either presenting yourself or helping to manage these programs, please also indicate as much when you reach back. And with that, that's about all I've got. I'll go ahead and close out today's program. I want to thank everybody again for your time today, both the presenters and the attendees, and hope everybody stays safe.